Welcome back to a brand new deep dive. And, I want you to imagine something for a second. Imagine running a business where you do exactly the same work every single day.
Right.
You produce the exact same volume of product, you employ the exact same thousands of hardworking people, and your underlying operations are they're humming along perfectly.
Sounds pretty good so far.
Right. But then, despite all of that consistency, your top-line revenue drops by over $1 billion
Sure.
in just 12 months.
Oh, wow. Yeah, that's brutal.
It's staggering. And today, we're looking at a company facing that exact reality, Cal-Maine Foods. They're the largest producer and distributor of fresh shell eggs in the United States.
Yeah, and it really is a stunning reversal of fortune, at least on paper. We are analyzing their fiscal 2026 fourth quarter earnings release, along with their full year Form 10-K. And the headline numbers here, they present a really fascinating paradox.
Which is exactly our mission for this deep dive, because, we want to look past that initial shock.
Right, because the surface level financials look like a company that's just in free fall.
Exactly. But we're unpacking how this company, which just reported this massive drop in revenue and an actual quarterly loss, is quietly engineering a highly resilient, diversified food empire right under our noses.
Yeah, they are systematically trying to escape what we call the commodity trap.
Okay, let's unpack this. Because the contrast between last year and this year is just jarring. I mean, if you think back to last year, everybody listening probably remembers the sticker shock at the grocery store.
Oh, yeah. Everyone was talking about it.
Egg prices were at these eye-watering record highs. But now we're looking at this current quarter, and those prices have plummeted to historic inflation-adjusted lows.
The whiplash is severe, honestly. If you look at the exact figures for fiscal 2026, their net sales came in at $2.91 billion.
Which, I mean, that's still a huge number.
Right. $2.91 billion is massive in isolation, but it represents a 31.7% drop from the $4.26 billion they posted in fiscal 2025.
I am still trying to wrap my head around a drop of over $1 billion in top-line revenue in a single year. And that's without a major scandal or like a massive product recall.
Nope, nothing like that. And the bottom line took an even more dramatic hit. Net income plummeted from an incredible $1.2 billion in 2025 all the way down to $316.6 million for the full 2026 fiscal year.
Wow.
Yeah. And the fourth quarter fiscal 2026, that was where the pain really crystallized. They posted a net loss of almost $35.9 million in Q4.
A loss.
A net loss, which translates to a loss of 76 cents per share. So you literally go from $1 billion windfall to bleeding capital in the span of 12 months.
See, I have to challenge the business model here. Because if your revenue can just evaporate like that while you're doing the exact same job, you don't really have an operations strategy, right? You have a survival strategy.
That's a very fair point.
You're basically chained to an unpredictable biological engine. So how do the mechanics of this market actually dictate those wild swings?
Well, it really comes down to the brutal reality of agricultural commodities and the fundamental concept of demand inelasticity.
Okay, break that down for us.
Sure. So the massive variable here, which is entirely outside of Cal-Maine's control, is highly pathogenic avian influenza, or HPAI.
Right, bird flu.
Exactly. Back in 2024 and 2025, this virus swept through the U.S. poultry industry. And to stop the spread, farmers have absolutely no choice but to depopulate, which means destroy entire infected flocks.
Which is devastating.
It is. Across the industry, 40 to 45 million commercial layer hens and pullets were completely wiped out.
Actually, I want to pause on the terminology for a second there, because we hear the term layer hens a lot in the news, but the report specifically mentions pullets.
Ah, yes.
For those listening who aren't steeped in agricultural terminology, how does a pullet factor into this whole supply chain?
So a pullet is essentially a young hen that has not yet started laying eggs. She's not productive yet.
Okay, so like a teenager bird?
It's exactly, a teenager. And the reason the destruction of pullets is so critical to the market pricing is the time lag. Because when a flock is wiped out, you cannot just replace a producing hen overnight, right?
Because they have to grow up.
Exactly. You have to raise pullets, which takes months before they mature into productive layer hens. So this creates a really prolonged, agonizing shortage in the market.
And that leads directly to the demand inelasticity you mentioned earlier.
Spot on.
Because if the price of, say, a luxury car doubles, people just stop buying it.
Right. They just wait.
But if the price of eggs doubles, bakeries still have to bake bread, restaurants still have to serve breakfast, and families still need a chief source of protein for their kids. People grumble, But they still buy the carton.
Yeah, they complain, but it still goes in the grocery cart.
The demand doesn't drop to match the constrained supply, so the price just skyrockets.
And that mechanism is the sole reason Cal-Maine made $1.2 billion in profit last year. They were selling a deeply scarce, highly demanded commodity at a massive premium.
But high prices always incentivize something.
Always. High prices incentivize frantic rebuilding. The entire industry aggressively repopulated their flocks to cash in. So by fiscal 2026, the national flock hadn't just recovered, it surged.
Oh boy.
The USDA reported the layer hen flock hit 312 million birds by July 2026. That pushes it above the 5-year average. Some industry indices even estimated it was as high as 347 million hens.
So the pendulum swings aggressively in the absolute opposite direction. The market is suddenly flooded with eggs just as we head into the spring and summer.
Yep.
And summer is historically the weakest season for egg demand,
Yeah.
right? Because baking drops off after the winter holiday.
Exactly. You have maximum supply colliding directly with minimum demand.
And perfect storm.
The result was totally inevitable. Conventional egg prices crashed to historically low inflation-adjusted levels in the fourth quarter. When supply outstrips demand in a perishable commodity market, the price war completely falls out.
Which brings us to the really pivotal question for management. So if you are sitting in the CEO's chair and you're staring at a $35 million quarterly loss driven entirely by flock sizes and bird flu, how do you fundamentally restructure the business?
You have to build a moat.
Right. And the 10K report shows they are aggressively attempting this, starting with a completely new way they communicate their business to Wall Street.
Yes, this was a huge move. In the fourth quarter, Cal-Maine implemented a brand new segment reporting structure. Historically, an egg was just an egg in their financials.
Right.
But now they break the business down into 3 distinct operational segments: conventional shell eggs, specialty shell eggs, and prepared foods.
That's a massive signaling mechanism to investors.
It really is. They are declaring that they are no longer just a conventional egg farm.
Well, let's look at the data driving that signal.
Yeah.
Because the performance divergence between these segments is staggering.
It's day and night.
In the conventional shell egg segment for fiscal 2026, the average selling price per dozen plummeted 50.9%. The value of their core product was literally cut in half.
Yeah.
But then you look at the specialty shell egg segment, and this covers your cage-free, organic, pasture-raised, and nutritionally enhanced eggs. The average selling price for those only dropped 9.5% for the entire year.
See, the price stability in the specialty market is the first layer of their defensive moat. But the volume data is what truly validates the strategy.
Okay, what do you mean?
Despite the fact that conventional eggs were historically cheap, specialty volumes actually grew 2.4% for the year.
I am really struggling to understand the consumer psychology here, though.
How so?
Well, if you are pushing a cart down the grocery aisle and the generic white eggs are practically giving themselves away, while the organic pasture-raised carton next to them is still commanding a premium price, why wouldn't you trade down?
It seems illogical, right?
It defies basic household budgeting. Why didn't shoppers abandon the expensive eggs to save a few dollars?
What's fascinating here is that it reveals the incredible stickiness of the specialty consumer. The decision to buy a specialty egg is rarely driven by pure economics. It is driven by values and perceived benefits.
Like animal welfare.
Exactly. A shopper switches to cage-free or pasture-raised because they have deep concerns about the animals. Or they switch to nutritionally enhanced eggs because they want, say, higher omega-3s in their family's diet.
So it's an intentional lifestyle choice.
Right. Once a consumer internalizes that value proposition, buying the conventional egg feels like a compromise of their principles or their health standards.
It becomes a moded identity. They are no longer buying a commodity. They are buying a brand that aligns with their lifestyle. I mean, Cal-Maine produces premium brands like Eggland's Best and Land O'Lakes.
Exactly. The consumer trusts that bright orange yolk of a pasture-raised egg.
And they don't want to go back to the pale yellow one.
Never. Furthermore, they are shielded by retail pricing strategies. Supermarkets often use conventional eggs as a loss leader. They price them incredibly low just to get shoppers in the door.
Well, that makes sense.
But they maintain strict margins on premium brands. So this insulates Cal-Maine's specialty revenue from that race to the bottom happening in the conventional tier. The specialty market simply doesn't suffer the same violent margin compression.
Okay, that structural advantage makes complete sense. But I see a glaring vulnerability here if I'm analyzing their risk profile.
What's that?
A cage-free egg is still a shell egg. It is still produced by a bird that that is highly susceptible to avian flu.
Yes, that is true.
The price might be more stable, but the biological risk to the supply chain remains entirely intact, which means to truly decouple their earnings from the agricultural cycle, they have to step outside the shell entirely.
And that realization is the exact catalyst for their third reporting segment, prepared foods. This is where Cal-Maine is fundamentally transitioning from a farming operation into a consumer packaged goods or CPG company.
And this is fairly new for them.
Right. Very new. Just a few years ago, this segment contributed virtually nothing to their revenue. But in the fourth quarter of 2026, prepared foods accounted for 10.9% of their total net sales.
Wait, so if you combine specialty shell eggs and prepared foods, they made up over 53% of total Q4 sales.
Yep. More than half of this company's revenue is now insulated from the conventional commodity bloodbath.
That's incredible.
They engineered that shift through aggressive capital deployment, basically buying their way into the CPG space. They acquired Echo Lake Foods, which is an established manufacturer of frozen baked goods and egg products.
Right.
They purchased assets from Creighton Brothers to expand their hard-cooked egg capacity. And most notably, they bought consumer-facing retail brands like Vans, which produces frozen waffles and pancakes.
Think about the mechanics of this shift for a second. It's like if you are a farmer selling raw potatoes, you are at the absolute mercy of the global potato market. If there's a bumper crop, your potatoes are worthless. But if you take those potatoes, you slice them, fry them, put them in a brightly colored bag, and call them potato chips,
Yeah.
everything changes.
You've added value.
Exactly. You dictate the price to the supermarket. The shelf life goes from weeks to months, which shifts the leverage from the buyer entirely back to you, the seller. Cal-Maine is doing the exact same thing here.
It's brilliant.
Selling raw eggs is a vulnerable agricultural play. Selling a box of frozen protein waffles is a high-margin CPG play.
The potato chip analogy captures the mechanism perfectly. In the CPG space, you are selling convenience, brand equity, and shelf stability. The margins are significantly thicker, and the revenue is highly predictable.
Because retailers are ordering on a schedule.
Right. They order frozen waffles on steady, scheduled contracts. It is completely divorced from the daily spot price of an egg.
But I do have to push back on the timing of their capital allocation here.
Okay, let's hear it.
Because the report notes they just announced a new $54 million investment to expand their prepared foods production capacity.
Yes, they did.
And they are projecting this will increase output by 60% by the first half of fiscal 2028. But wait, they just posted a $35.9 million quarterly loss.
They did.
How does management justify dropping $54 million on a new factory expansion while the core business is bleeding cash?
It forces us to look closely at their balance sheet rather than just the income statement, and this is where Cal-Maine's historical financial discipline really pays off.
Okay, walk me through that.
They took an operational loss this quarter, yes, but their balance sheet remains fortress-like. They hold deep cash reserves generated during those boom years of 2024 and 2025.
Ah, so they bank the profits.
Exactly. That liquidity allows them to fund a $54 million capital expenditure without taking on toxic debt, even during a down cycle.
And the cash reserves also gave them the ammunition to go into the open market and repurchase 396,000 shares of their own stock during the fourth quarter.
Right.
They spent $30.1 million doing that.
Cool.
If you are holding Cal-Maine stock right now, you are watching the company buy back shares at what they clearly believe is a depressed valuation. And they still have over $320 million left on their repurchase authorization.
It is a textbook counter-cyclical capital allocation strategy. You buy when things are cheap.
Yeah.
However, the short-term pain for retail investors is very real, specifically regarding the dividend.
Oh, the dividend. This is fascinating.
Cal-Maine operates with a highly unusual variable dividend policy.
Unlike most mature corporations.
Exactly. Most pay a fixed, predictable dividend every quarter, regardless of minor earnings fluctuations. But Cal-Maine pays out exactly 1/3 of their quarterly net income.
Which is a radically transparent way to handle the commodity business.
It really is.
It prevents the company from ever having to borrow money just to fund a dividend payout during a bad quarter, which destroys long-term shareholder value.
Yeah.
If they make $1 billion, investors get a massive windfall. If they make a little, the check shrinks.
But the punitive side of that policy is currently in effect, because if they post a net loss, the dividend is entirely suspended.
So no check.
Consequently, there is no dividend for the fourth quarter. But the mechanism is even stricter than just a simple suspension.
Wait, how so?
The policy mandates that they must completely recover any cumulative losses before they can resume payouts.
Yeah, so let me get this straight. Even if they return to profitability next quarter and make, say, $10 million, they can't just pay out a third of that.
Nope.
They have to fill the entire $35.9 million hole generated by this Q4 loss before a single cent flows back to the shareholders' pockets.
That is exactly the hurdle they face. They have to fill the hole first. But the data suggests that recovery might happen faster than the Q4 numbers imply.
Okay, good news then.
Yeah, the 10K report notes that heading into the first quarter of fiscal 2027, the underlying commodity market is already experiencing a violent correction upward.
Actually, the report cites data from Urner Barry on that. And for anyone listening who isn't trading agricultural commodities every day, what actually is Urner Barry?
Good question.
And how does a benchmark report dictate the physical cash a supermarket pays Cal-Maine?
Urner Barry is the premier independent price reporting agency for the poultry and egg industry. Because eggs are traded in opaque bilateral markets between producers and grocery chains, there isn't like a centralized stock exchange for them.
There's no NASDAQ for eggs.
Right, no egg NASDAQ. Instead, supermarkets and producers sign contracts where the price they pay for a truckload of eggs is mathematically pegged to the daily Urner Barry quote.
Ah, I see.
So if the Urner Barry index moves up 10 cents, Cal-Maine's realized revenue on those contracts moves up almost instantaneously.
Well, that makes the recent data incredibly significant because early in the first quarter of fiscal 2027, Urner Barry reported egg prices averaged just 72 cents a dozen.
Which is low.
That was 54% below the previous year. But the report states that in a matter of just a few weeks, those prices strengthened by more than 90%.
Yeah, we are seeing early, aggressive indicators of supply and demand realigning. The massive oversupply from the summer is being absorbed. Furthermore, we are shifting into the fall season.
Back to school, baking starts.
Exactly. Historically, as schools open and consumers begin early holiday baking preparations, the base-level demand for shell eggs naturally rises, and that creates a supportive floor for pricing.
So the narrative arc here is complex, but it's highly strategic.
It is.
They absorbed a punishing blow in Q4 due to an oversupplied commodity market. But because they maintained zero reliance on debt and hoarded cash during the boom times, they survived the quarter without compromising their future.
Precise.
Now, the underlying market is recovering just as their new, highly profitable prepared foods capacity is being built out.
They are systematically dismantling their identity as an agricultural producer, and they're reassembling themselves as a diversified, margin-protected food company. They are utilizing the massive windfalls from the unpredictable years to buy permanent insurance against the bad ones.
Which is incredibly smart. But, it leaves us with a broader, somewhat unsettling implication to ponder here at the end.
Let's hear it.
We have focused intensely on what this strategic pivot means for Cal-Maine's balance sheet and their shareholders. But consider the perspective of the average family navigating the grocery aisles.
Right.
If the largest, most efficient producers of cheap conventional staples companies producing the base layers of our diet like eggs, milk, and wheat, if they all aggressively pivot their capital and focus toward premium, value-added CPG products to protect their profit margins, what happens to the affordability of basic food?
That's a scary thought.
If the entire industry views plain, conventional food as a commodity trap to be escaped, will affordable basics eventually become an afterthought, left to the mercy of violent supply shocks while all the reliable investment flows into the premium frozen aisle?
It suggests a profound structural shift in the food landscape, one where predictable corporate earnings are prioritized over the mass accessibility of basic nutrition.
And it is a shift we will undoubtedly be tracking as this transformation continues. Thank you for joining us on this deep dive into the 10K. Keep questioning the mechanics behind the headlines, and remember, the next time you reach for a box of frozen waffles, you might just be looking at the future of the egg industry. See you next time.